Well, good morning, Singapore, Sydney, and everywhere in between. I'm David Scott, market analyst here at Citi Index, and thank you for joining me on this weekly webinar. Look, I'll leave the risk warning up on the screen for the time being, and just provide the reminder that this is going to be general advice in only and represents the views of myself. I like to go and make this as interactive as possible, so anyone listening in, if you've got any questions over the course of what I'm presenting, or any other questions that you may have, please shoot them through on the platform, and then my team will go and shoot them through to myself, and then we'll be able to go and have a look at any of the potential answers. But anyone who chooses to go and do that, just be understood that you're doing it as your own free will. Well, good morning. It's been a pretty big week. We've got a big event coming up later on tonight with the non-farm payrolls report in the States. And then next week, it's going to be one for the ages. Really, really important events. The Federal Reserve meeting, of course, on Thursday. But before that, and arguably the far more important event, of course, is the US presidential election. So what this will focus on today is those three particular events, because no offense to anything else that's out there at the moment, but they're really not going to go and be anywhere near as influential across broader markets as those three numbers. I might get straight into it and have a quick look here. Starting off with payrolls later on this evening, our time here in Asia. One thing I've heard a lot recently is that this is kind of almost an irrelevant payrolls report. It's kind of superseded by what's going on with weather, what's going on with strikes with Boeing in particular, and also, of course, the election and what it may mean for the economy and Fed policy moving forward. Well, that's kind of true to a certain point, but I don't think it's irrelevant in the slightest. Now, one thing I'm still going to be pretty certain on at this point is that even though we're told not to go and focus on it, even though it's a rubbery figure, even though we know it's going to be weather impacted on this occasion, the market reaction initially is going to be almost certainly from the payrolls figure. You can see down the bottom there, a growth of just 113,000 is expected. Potentially, the ADP, National Employment Report that came out on Wednesday, was a lot stronger than that. And it gets a bit of a bad reputation in the marketplace because it was very, very poor indicator for payrolls up until around about the last 12 months. But since then, it's had a fairly decent track record, in my opinion, to go and track what's going on with private sector payrolls. So it was very strong, so there could be a potential upside surprise there. But just remember that the Fed is graded, its mandate is based on the unemployment rate. So it's far more influential as to what happens with the unemployment rate, which is derived from the household survey. So for those of you who are not aware, the way that the payrolls report is structured is that you have the establishment survey, which is where the payrolls number is derived from, and then you have the household survey, where you get the unemployment rate. You also have employment change, you have unemployment total, underemployment, underutilization, and that's going to be carrying a lot more weight on this occasion because of all those disruptions I talked about, particularly when it came to the weather. It doesn't go and really encapsulate those impacts because you have to be completely unemployed over the course of the entirety of the month to go and actually be registered as unemployed in that survey, whereas the establishment survey can go and pick that up. And so that's why on this occasion, even more so than usual, if the markets react really violently to a big miss or beat when it comes to the payrolls figure, but the unemployment rate is in line with expectations or higher or lower, I would go and look to go and fade the move in favor of what the unemployment rate is signaling. So you can see here on the screen, also underutilization, it's called U6 rate. That's really important too because it gives you a sense as to what we can expect from labour market conditions, how tight things are in the labour market. And you generally see when people, this is categorised as people who are either unemployed or employed but like to work more hours but can't due to economic reasons, which means that they just basically can't get the hours that they want to go and work. And if you see deterioration or a strengthening in that particular rate, it tells you there's changes going on in the broader labour market, and it can go and lead to other down the line. So to me, that's one of those things as well to keep a close eye on. So in terms of ranking that I'll be looking at tonight, it would be the unemployment rate, underutilization rate, then the payrolls figure. Of course, wages growth, always worth having a look at, but to me, it's not going to be the most important factor tonight. The payrolls number, again, expect to see some volatility there, and you can go and strip it back for those weather disruptions, but to me, there's going to be too much noise in it, so focus on unemployment. Let's get to the election playbook, because this is going to be the major event that we'll be dealing with next week. First and foremost, those of you who are not aware, we've got a live blog that we'll be running through the course of the day. So not just myself and Matt Simpson in Asia, we'll be focusing primarily on what's going on in some of the Asian markets, I would imagine, but we're going to have most of the team, especially our US team, also covering the event live. So rather than trying to go and look at the political implications about what goes on, we're going to be focused on almost entirely what the markets are about, what's happening there. So we'll get some pretty good insights as to what's coming through early on as well. And the big question at the moment, looking at what's going on, the polls, they're very tight. The betting markets are suggesting that Trump is much more of a favorite than what the polls are suggesting. But the key question, have the pollsters gone and overcompensated for the silent Trump supporters that were not counted and not found in previous polling before the 2016 and 2020 elections? That's going to be the other focus here. And I think we'll get a pretty good indication early on, because North Carolina, Georgia, Florida, I think is going to provide some pretty good insights as to where we're sitting relative to the polls in those particular states. And if there's uniformity in the results there, you can probably go and start to go and extrapolate that across the broader parts of the country. So we might go and get an early sense from those states in particular, in my opinion, as to what's going on that particular front. I've said here that market risks are asymmetrically skewed. Now, what does that mean? Well, it means that if you go and have a Trump victory or a Harris victory, the market impact is not going to be the same. The way that I get the impression right now, and it's very hard to go and make a really strong assertion as to what's priced in, but I think markets are now not only expecting that Trump will become the president again, but also a reasonable risk that we'll go and see a red wave. And that might explain some of the market ructions we've seen of late, because it's not necessarily going to be the fantastic news that everyone is expecting just because of what's going on with the tax policy. There are other things, of course, as well, such as tariffs. So yeah, just be cautious about getting too bullish if you go and hear commentary about red or blue waves, because there'll be some fairly significant market implications, which I'll get to in just a second. Just to go and reinforce though, if Harris was to go and get up, then you'd expect to go and see a much larger market reaction. A lot of those Trump trades will be unwound very aggressively. And so we'll get to some of the other details quickly on the FX front there. So to me, there's much more of a risk of a Harris victory when it comes to market impact and market volatility than maybe if a pure Trump victory. Here's how I look at it from an FX perspective, and I'm not going to go through individual pairs as to exactly how it's just going to play out. We'll be here for hours on end, and you'll probably switch off. So I'm just looking straight from a US dollar perspective. What's going to be most bullish for the US dollar story, and what's going to be the most bearish? And you can just see it from top to bottom. If we get a Republican clean sweep, so that's you get presidency, Trump, and you get both the Senate and the House flip red, then that means you've got open slather when it comes to the potential for fiscal spending. Trump is more reflationary in the terms of the policies that have been laid out so far. That means higher yields, and as we'll get to in a second as well, that would generally mean a stronger dollar at the moment, at least based off the correlations that we've seen over the past month or so. A Democratic clean sweep would probably be, marginally dollar bullish as well, because again, it opens the ability to go and spend quite freely when it comes to some of the fiscal policies, although what the Democrats have laid out to this point don't look to be anywhere near as reflationary as the Republican policies. In terms of the markets, what they probably would like the most, it's the next one, Trump victory, but then a divided Congress. So at the moment we have the Democrats hold the Senate, and then the House is held by the Republicans. If we're going to get a kind of repeat of that again, it would go and make it very difficult to go and push through those really aggressive agendas when it comes to different policies. Markets would generally like that, I'd imagine. If you see Kamala Harris becomes president and you have a divided Congress again, so one house to the Senate, one house to the Republicans, one to the Democrats, then potentially that would be probably the biggest damage to the US dollar, because not only would that go and make it very difficult for the Democrats to push through their agenda, but because they're not as reflationary, you can imagine that the Fed might have some more room to go and cut rates a little bit more aggressively than what's currently factored in. The Fed meeting on Thursday morning, very early our time here in Asia. It's likely that the Fed's going to cut rates. That's straight off the bat. It would take a phenomenally strong payroll support tonight to go and knock markets off its perch. You can see about halfway down there. There's 23.6 basis points that are priced in for that particular meeting on November 6th. So that's almost a lock. But you can see that over the final two meetings of 2024, we've got around about 43 basis points priced. So it's not deemed a dead certainty that we'll get 25 basis point cuts at this meeting. So this payroll support, if we were to get a really strong number, and I'm talking about like another blowout report that we saw back in August, the September reading, if it came in very, very strong, sorry, the October reading, I should say, very, very strong, then what it would do is it would go and put pressure on the Fed to say, hang on, maybe there's not a need to go and cut, maybe we've got some time up our sleeve. And the way that I look at it at the moment, if we were to get a really strong number, and it has to be really strong, so I'm talking about unemployment maybe down to 4%, very strong payrolls growth coming through as well, and maybe an acceleration or very sticky signs of wage inflation, that could go and prompt them to go and skip a meeting. Now, I hear the argument, it would lose credibility, it would lose face if it was to go and not cut in November. It wants to save face. I don't buy that, because this is a meeting where there's no dot plot, there's no forecast material, so all we receive as traders is the Fed statement and the press conference from Jerome Powell. To me, it'd be far more likely that it would go and skip the November meeting and then maybe wait to go and see what happens in December, be able to go and put out fresh forecasts, then base their move around that particular area. But of course, the Fed was signaling a further 50 basis points worth of cuts back in its September meeting. So it's going to take something pretty phenomenal from the other jobs front. That's really the only main thing that can go and focus on right now. And then, of course, we get a really clear and definitive result in the election, and hopefully it does come by the time the Fed meeting happens. Then that too could go and maybe move the other dial a little bit. But the Fed says it's apolitical. I don't believe that for a second, but I don't think it's going to go and impact maybe on the near term. Just want to go and look at some of the how it's interacting with broader markets, and this is Citi's Economic Surprise Index. And so, in the red shading, the top pane, you can see for the United States. In the blue, you can see for the Euro area, and in the black is for China. Now, those of you who have not come across this particular market instrument, basically Citi goes and tracks economic data in these particular areas, how it goes and prints relative to market expectations. And so if you have a result that's above zero, it indicates that more data than not is beating expectations. And the further away from zero you go, the greater the magnitude of beats that we're seeing. You can see that there's been a really, really stark turnaround in the US in particular. We've got back to levels where the proportion of data beats is now the highest that we've seen since April. And that's really been fueling a lot of the US dollar strength that we've seen recently. But this sign's starting to go and creep in that the bar that's been set very low for economic growth and economic data in the likes of the Euro area and China is now starting to go and flow through to better data outcomes relative to expectations. You can see that for the Euro area data, it's almost back to flat. So for a large period of the past few months, we've seen nothing but really, really lots of downside misses. But all of a sudden now it's much more balanced in what we're seeing, beats and misses. And you can see the same again for China. There's been so much pessimism out about the Chinese economy. It too, the ratio of data undershoots is now the smallest that we've seen since June of this year. So there is signs there from a contrarian perspective that when we start to go and see that go and push into positive territory, and it's likely to go and do that given expectations are still very, very low, then all of a sudden you've got the bar for US economic data to get much higher, and then you start getting disappointments, and that's when we could go and see a bit of a turnaround. And if you look at what's been going on in some of the FX charts, and we'll have a look at that towards the end, you can see that the euro has already started to respond to some of the improvement that we've seen over the course of recent days and weeks. This is the Fed pricing for over the course of this year and out to the end of 2025. And what we're looking at right now is that a couple of months, not even a couple of months ago, it's about 6 weeks ago, we had 9 rate cuts priced into the curve between those 2 periods. So that's really big, quite aggressive. And then what we're seeing since then is now we have less than 5 priced by the end of 2025. So markets have been recalibrating their expectations based off what we've been seeing with the US economic data right now. It's still a decent easing cycle. It's not a huge one in the broader scheme of things, but we're not dealing with a crisis at this particular moment. So that probably explains what we're looking at right now. But we're not far away from the Fed, in my opinion, having to go and acknowledge that the US economy is really outperforming, growing above trend and growing at rates that typically would go and see inflation pick up and unemployment turn lower. And that's what we're starting to go and see in some of the indicators of late. And if we keep seeing that over the next month or so, the Fed will have to go and fold, and there's no way that it can go and be justifying they need to go and keep cutting rates when the economy's rollicking along at a near enough 3% seasonally adjusted annualized pace. So the markets have been moving that very aggressively, and I think it's about right at the moment where we sit, because the risks are clearly, given what's going on with the data, towards less cuts coming through. And this is just the flow-through effect to what's going on with Fed funds pricing to what we're seeing when it comes to further out the US Treasury yield curve. On the left-hand pane, you can see a US 2-year government bond yields, and then in the right-hand pane, you've got 10-year US Treasury yields. And I've just gone and looked at the 20-day rolling correlation between a whole variety of different FX pairs. And from top to bottom, in black, you've got Euro USD, in green, you've got cable. In blue, you've got Aussie dollar. In red, you've got dollar yen, and also in purple, dollar Chinese yuan. And whilst there's been a little bit of a turn in terms of the strength of the correlations or inverse correlations, that's primarily, to me, really reflects what's been going on when it comes to month end, and also maybe a bit of position adjustment before the election, because obviously people are trying to go and take some risk off the table, given there's so much at stake with that binary kind of outcome. So at this point in time, I expect that we're going to see that still the US interest rate outlook is going to be very, very influential when it comes to some of the other broader market movements out there in the FX space. So yeah, that's the playbook basically when it comes to the US economic data. The fiscal policies, whoever wins the election, are going to be very influential on the front end of the curve, Fed rate expectations, and then that will filter through to the FX space. Let's go and have a quick look at what's going on when it comes to some of the other charts at the moment. I'm not going to go and run through everything out there at the moment because a lot of it's going to change, but a lot of interesting moves that we've seen in anticipation of what's coming up next week. We're going to kick off just starting off with S&P 500 E-minis. You can see here bumping up against an uptrend for a long period of time, especially of late. Price broke through and then it's just gone whooshka straight down, and you can see it's gone and stopped dead at the 50-day moving average. So that area there, 5670 as well, beneath that would be the next level to go and focus on. And then beneath that, there's not a lot visible technical support. So keep a close eye on those levels. But clearly right now, you can see that the price, the 50-day moving average, is being pretty influential at this stage. But when you look at what's going on with RSI 14, it's been trending lower for a while as the price was still going higher as well. So there was a bit of divergence up until the past week or so. And that's played out, and that may go and explain as well that there was price that was grinding higher, but there wasn't the momentum behind it. And you can see MACD as well has gone crossed over quite a while back, so it's confirming that bearish signal on price momentum. Nasdaq, we had a couple of the members of the Magnificent Seven out, of course, over the last few days, and you can see Nasdaq a very similar kind of move as well. Uptrend. Same time, had divergence here between RSI 14, and then broke the uptrend with conviction, and it stopped at the moment, Hasn't quite got to the 50-day moving average, but you can see around that particular level at the moment, again, would be the first near-term look. Again, MACD has crossed over, so confirming the bearish signal coming through from RSI 14. It just looks heavy at the moment, and we've had such a great run in these indices over the course of this year that it's not surprising you're going to see some of, no momentum is lacking, the price is rolling over, because if you get it wrong after such a dramatic rise, and of course with so much excitement already regarding AI built in, it can become problematic. I want to have a quick look at SPY futures here for those listening on in Australia. You can see here much the same story. Had an uptrend, broke that with conviction with a bearish engulfing candle, whole string of dojis, and then we had another bearish engulfing candle, and then of course yesterday when it broke down, closed beneath the 50-day moving average, and then I remember doing a video yesterday on a trade recommendation. So the first target is 80.80. Well, we're almost basically there right now. You can see RSI 14 cleared downtrend as well. MACD as well has gone and confirmed that bearish signal on price momentum. Beneath 80.80, there is not a lot of visible support that you can go and see, at least in the indicators that I use. So realistically, we could be looking at a more pronounced sell-off if we go and break 80.80. So keep a close eye on how we go and fare today. The 200-day moving average around about 7863, where it sits today. The price has been very respectful of that on many, many occasions over recent years. So if we get down to that level, that will give you a good setup to either go short or long, depending on how it interacts with that level. At the moment, clearly, selling rallies is favorite in this particular market. So have a quick look at some of the Forex markets as well. I won't go through all the pairs. Euro is one that I want to go and focus on because I talked about the divergence that we'd seen between the economic data, then all of a sudden the euro area is starting to go and look half decent. Well, you can see here, we've had a nice bounce off very, very important uptrend here that the price has been very respectful of in the past. And again, it has been the case. Didn't even go and get to it this time. You can see here, this bullish hammer candle, you can see really kind of set the tone. And then we're seeing a pushback above the 50-day moving average. And then this downtrend you can see here dates back to the highs seen a couple of years ago. And you can see the price has been respectful of that level on multiple occasions, apart from this one false breakout that we saw back in August. And now we find ourselves sandwiched against this level. So that's going to be an important one to me when it comes to directional risk here and now. You can see that RSI 14 is trending higher. And then now you've also had MACD crossover from above. So it's confirmed the bullish signal. So it looks like if we manage to go and clear this downtrend, to me, we can go and get some more upside ahead. How much though, unless it's accompanied by a real deterioration in US economic data, is probably a little bit debatable. Dollar yen, incredibly correlated still with US interest rate markets. I know a few of you are probably wondering what I just write the same thing over and over again, but that's what it is when it comes to this particular pair. You can see the price has been this uptrend acted as resistance initially, broke through, and then it's now starting to go, and initially when tested, it's started to go and act as support again. That and the 200-day moving average are looking pretty key near term. You can see a couple of dojis, really inconsistent, then this bearish bar that we saw here. Haven't broken the uptrend though, so to me it's too early to go and get too excited. The market's got pretty excited about UATA press conference yesterday, sounding more hawkish. I went and listened to the transcript in English. It didn't really sound any different to what he's been saying recently. Maybe there was some expectation that he might go and pull back given the Japanese election outcome. But to me, anything that's been driven by the Japanese side of the equation right now is something that you can be fading, in my opinion. Let's go finish off with the Aussie dollar. It's trying to bounce. It's trying to put in a bottom as well. It's broken RSI 14, the downtrend it's been sitting in. Not yet confirmed by MACD, but it looks like it's going to start to go and potentially go and flick higher and maybe go and confirm that bullish signal. You can see here, had a doji, but then you had this bullish pin. Haven't gone on with it right now, but it looks like the Aussie's trying to go put in a base right now, but there's still so much uncertainty at the moment. And the one thing that you need to know with the Aussie, like the Japanese yen, it's been incredibly correlated with US short-end rates in particular of late. Got a question I think that's come through. Let me go and have a quick look at what's going up. Excuse me as it comes up on the screen here. So Liam, either way about the election, the equity markets will like it. Look, maybe it was misspoken. It's certainly not going to be, any outcome is going to be great when it comes to the election. When you're talking about outcomes, you want policy gridlock, in my opinion. So what does that mean? So it means you want a divided Congress, you want to go and have the inability to go and push through really meaningful reforms, in my opinion, because that to me is basically a continuation of the status quo. I can understand why some people like the idea of a red wave in particular, because what that would go and mean is the prospect of large-scale tax cuts coming through for corporates, potential intervention when it comes to Fed policy and the like, given some of the sound bites that Donald Trump's been offering. But I think it's a negotiating tactic, but the idea that you're going to go and slap 10% tariffs on every single import coming into the United States, and what that would go and do for inflation, and what that would go and do towards demand for US debt, I think would be a really dangerous cocktail. And I'll be very concerned to go and see what would happen further out the Treasury curve. I'm talking like 10 years plus, if that kind of outcome was to go and take place. Because if you get a really big upward adjustment in the risk-free rate, then that's going to go and make readjustments go and take place across asset valuations on every sphere. So that's, to me, it's not as bullish as some make out to be. Yes, there'll be likelihood of tax cuts, but that doesn't necessarily go and mean everything is going to be great. In an environment where you potentially go and slow the economy down, yeah, I'd be very skeptical to go and see an extenuation of that particular move. So yeah, just to go and reinforce, right now, to me, it would be, you'd want to go and see a divided Congress would be the other optimum outcome, probably be with a Trump presidency. With that, I might go and just put up the disclaimer one more time here. If any other questions come through, otherwise we'll then go and wrap it up and go and get to the rest of the day. Looks like we've got everyone accounted for. I just want to go and say thanks to everyone who turned up today. Yeah, really important that I know it's got to be keep on your toes, be nimble, and be ready to go and act. The one thing that I'm really looking forward to over the next week or so is that we're going to go and get an enormous improvement in clarity. And when you have clarity, you have the opportunity to go and look at swing trades. You have the opportunity to go and look at an extension of trend trades. And I think that's going to go and be really beneficial. So I'm not sure if you've noticed out there in the markets, but certainly I have, trying to go and come up with ideas with price signals and patterns and the like, is that a lot of the stuff that you can go and put faith in up until the last week or so has just really broken down. And that indecision is really making it difficult. Lots of choppiness going on in markets. But after the election outcome is known in particular, and then how the Fed is likely to go and respond as well, it's going to go and be an environment where I think we're going to see some pretty decent trends and turning points. To me, that's really the time to go and start going and adding to bigger positions. Best of luck with your trading, and have a fantastic weekend. And I'll catch you next week to go and digest everything that we're about to go through. Good luck.